Most UK businesses lose thousands simply because they don't claim the reliefs they're entitled to. In this video, I'll reveal the 2026 corporation tax reliefs that could dramatically boost your profits.
Did you know that thousands of UK businesses overpay on their tax bill every single year without even realizing it? Well, for 2026, the tax landscape is shifting again. And while that brings its own set of challenges, it also opens up some massive opportunities for savvy business owners to save money. So let's make sure you're one of them. Let's be honest, for a lot of us, the answer is probably yes. The UK tax system can feel like a maze of reliefs and allowances, and it's just far too easy to leave money on the table, money that really belongs back in your business, funding your growth, not sitting in HMRC's coffers. So, to help you navigate all this, we're going to break down a guide developed by the expert tax advisors over at My Tax Accountant. They've really boiled down these complex changes into a clear, actionable roadmap for 2026. Okay, let's get into it. First up, let's talk about capital allowances. Now, this is all about how the government is trying to encourage businesses, just like yours, to invest in new equipment, new machinery, and other assets to really drive productivity and growth across the country. And right away, we see this classic give and take from the government. On one hand, the long-term slow burn relief you get on your existing assets is actually being reduced. But on the other hand, they've introduced some huge upfront incentives for new investment. Now, this catches a lot of people out, because if you only focus on the reduction, you're going to miss the bigger picture. So let's break down the challenge first. From April 2026, the main rate of writing down allowance, or WDA, drops from 18% down to 14%. Think of your main pool as a kind of pot that contains all your older business assets, machinery, office furniture, computer equipment. A lower rate just means it's going to take you longer to get that tax relief back. But here's the massive opportunity that completely changes the game. The government has made full expensing a permanent part of our tax system. And this is a big deal. It lets limited companies deduct 100% of the cost of qualifying new plant and machinery from their profits in the very same year they buy it. And crucially, there's no limit. Okay, so what if you're not a limited company, or maybe you lease out your equipment? Well, full expensing doesn't apply to you. And that's exactly why this next change is so important. You'll definitely want to hear this part. From January 1st, 2026, there's a brand new 40% first-year allowance, and it's designed specifically to fill those gaps. So how do all these pieces fit together? Well, this table breaks down your options really nicely. For limited companies buying new equipment, full expensing is your go-to for 100% relief, no question. For sole traders, partnerships, or businesses that lease out assets, that new 40% allowance is a vital new tool in your kit. And we can't forget the annual investment allowance, or AIA. It gives 100% relief on up to £1 million of spending, and really importantly, it covers secondhand assets, which the others don't. So the crucial point here is that you need a strategy for your capital spending. The expert tip is to always use your £1 million annual investment allowance first. It's just the most flexible tool you have. Once that's used up, then you can look to full expensing or the new 40% allowance for any leftover spending on new assets. All right, let's shift gears a bit. We've talked about investing in physical assets. Now let's talk about investing in innovation. Next up is research and development, or R&D. And this is another area that has gone through some major reforms, which have simplified the system, but also brought in some very strict new rules. First things first, let's be absolutely clear on what HMRC actually means by R&D. It's not about being innovative in a marketing brochure sense. It's about a genuine technical challenge. Imagine a small software startup in Birmingham trying to integrate two systems in a way no one's done before. They hit a wall. They aren't even sure if it's possible to solve it. That struggle, that process of trying to overcome a real technological uncertainty, that is the R&D. Thankfully, the old, confusing system with two separate schemes for small and large companies has gone. Now, most businesses claim under a single merged scheme. This gives you what's called an above-the-line credit of 20% on your qualifying R&D spend. In simple terms, this means it's treated more like income, which makes it more visible and beneficial, especially for companies that are currently making a loss. Now, what's really interesting here is what that 20% credit actually means in cash terms. Because the credit itself is taxable, for a profitable company, the net benefit works out to be around 15%. For a loss-making company, it's a bit better at 16.2%. But, And this is a big but. For loss-making SMEs that are really heavily invested in R&D, there's a separate, more generous scheme that can provide a cash benefit of up to 27%. That can be a genuine lifeline. Okay, here's where most people get tripped up. Before you can claim a single penny of relief, you now have to submit a detailed additional information form, or AIF, to HMRC online. This isn't a simple form. It requires detailed technical explanations and cost breakdowns. And the order you do things in is absolutely critical. I honestly cannot stress this point enough. You must submit the additional information form before you file your main company tax return. If you get that order wrong, HMRC's computer system is literally programmed to automatically reject your claim. It's dead on arrival, no matter how groundbreaking your R&D actually is. All right, let's move on to a really powerful but often missed opportunity that also has a positive environmental impact. I'm talking about land remediation relief. It's all about the costs involved in cleaning up land. This is genuinely one of the most generous tax incentives out there. Land remediation relief lets a company claim a corporation tax deduction that's equal to 150% of the cost of making a contaminated or brownfield site safe and usable again. Now stay with me here. This next point affects a huge number of property developers, house builders, and manufacturing firms. If your company has bought a site that has historical issues, things like asbestos, the dreaded Japanese knotweed, or chemical residues from past industrial use, the costs of dealing with those problems could qualify for this major tax relief. The key rules are that you didn't cause the contamination yourself, and it was already there when you bought the land. Finally, let's look at a change that's going to affect pretty much every single business that has a physical premises in England. I'm talking, of course, about the 2026 business rates revaluation. From April 1st, 2026, new multipliers, which are used to calculate your bill, are going to apply. Now, the government has tried to help smaller businesses in retail, hospitality, and leisure by creating lower rates for them. But as you can clearly see, the largest commercial properties are going to face a significantly higher multiplier. That means if you run a large warehouse or a big city center office, you need to be prepared for a pretty substantial jump in your rates bill. Phew, we've covered a lot of ground there. Everything from how you invest in equipment to how you power your innovation, clean up land, and manage your property costs. So let's make this simple and pull it all together into a clear action plan. So the crucial point in all of this is to be proactive. Sit down now and review your investment plans to make the most of those fantastic new capital allowances. Start documenting your R&D projects in real time. Don't leave it as a last-minute rush at year-end. If you're thinking about developing any sites, get them assessed for contamination early. And finally, find out what your new rateable value is going to be so you can actually budget for those business rates changes. Now, it is really important to state that everything we've talked about today is for general guidance. Taxes is incredibly complex, it's always subject to change, and how it applies to you will depend entirely on your specific business circumstances. And because of that, we strongly recommend that you speak with the expert team at My Tax Accountant before taking any action. They can give you tailored advice that's right for your business. You can reach them on this number or by email. And for more invaluable insights just like this, make sure you subscribe to the My Tax Accountant channel on YouTube. Thanks for watching.